Welcome to another Infographic Instant with Brian Michael. In this episode, we look at the question of how will China's bubble economics play out. In previous infographic videos, we've looked at the concept of structural change. In this episode, we'll be looking at that issue again, as well as the issue of nonlinear changes or jumpings in an economic system. In our paper on China's bubble, we used a model that tried to account for this structural change, and the figure you see in front of you tries to trace that change, and we've marked 4 points along that path. First point, we see China's property prices changing very quickly as risks build up in the system. So imagine that tomorrow we open the newspapers and we see that housing prices in China have fallen by 5% for some reason. It could be financial, it could be because of demand shocks, it could be whatever. Normally, this kind of effect would release pressures and risks that have been built up in the property market and the wider macroeconomy. But as we saw in earlier parts of the paper, a decrease like this would increase the fragility of China's economy because of the reliance on high property prices in the construction sector and the equities market, etc., etc. And so the red line in this figure shows the real relationship once we get rid of extraneous circumstances or extraneous variables that might pollute the relationship we're looking for. Now, as we see in the upper part of the figure, as property prices decrease very quickly, we expect to see an increase in the amount of risk, the basic probability of a large bubble forming in China's economy. As savings, as equity prices, as property prices start to fall, risks build up in the China macroeconomy. And that's depicted by point 3. There is a nonlinear adjustment, a sudden jump between the relationship in the risk of a bubble or a bubble popping and the relationship with equity prices, credit, those underlying variables that we were talking about previously. In the figure, we show that discontinuous jump from point 3 to point 4. And so we would expect to see a transition path something similar to the US, in that the bubble risk factor would suddenly decrease very much as all of the fundamental values of credit, savings, construction, etc., they fall to their equilibrium value or they undershoot. And we see then that prices have gone down very much in equity markets, in credits, savings have been depleted, and we see a wringing out, if you will, of risks in this economy. And so the challenge then for economists and for policymakers is to understand this bubble economics in the future. What exactly triggers this jump from point 3 to point 4? Because there's no doubt that the way property prices are changing in relation to credit, debt, etc. is very different structurally than it was before the crisis. And so we hope that our analysis of the Chinese situation helps to think through some of that deep structural change that is happening in these economies. This has been another Infographic Instant with Brian Michael.